Hey guys, welcome to Wealth Wisdom Financial Podcast YouTube channel. Don't forget, hit the like and subscribe because those things help, right? So today, as you guys might have listened in my last episode, it was, I guess, my last episode because I was being interviewed. And so you'll see me for a few minutes asking some questions or at least the intro, and then asking Amanda similar questions as we did last time, where I'm asking a CFP what they think about some of the infinite banking yourself type concepts and what they would do differently, or how that has given them a special different lens than a traditional practitioner or person in that world. So but before then, let's cue our intro video.
In a world where chaos seems to reign supreme, where uncertainty lurks around every corner, and financial markets are now more unpredictable than ever, there's one place you can turn to find clarity and control. Welcome to the Wealth Wisdom Financial Podcast.
Hey, I'm Brandon.
And I'm Amanda.
Join us as we dive deep in the world of personal and business finance
to assist you in navigating through the chaos and building the financial future you deserve.
We believe when conventional financial thinking doesn't get you where you want to go,
you need wealth wisdom.
So if you're ready to take control of your financial destiny,
tune in to the Wealth Wisdom Financial Podcast.
Because in a chaotic world, your money shouldn't be.
Subscribe now and never miss an episode.
All right. So, Amanda, following up from my interview, we asked AI some questions, and we changed them a little bit because you are not just a banking yourself practitioner, but you're also a certified financial professional. And they don't say a whole lot about our concepts in the training, but we wanted to know what your thinking is on some of these things. So I'm going to hand this over to you. But before I hand it over, I'm going to ask you this. As a certified financial professional, how do you see infinite banking concept fitting into a comprehensive, full financial plan?
Okay, just so everybody knows, we did Brandon's interview and then went back into the AI model and we just said, what would you change about these questions for Amanda Neely, CFP? And these are the questions AI gave us. I literally saw them like less than 5 minutes ago. So this is totally off the cuff. What I would say if somebody asked me this question in a random conversation. So here we go. How does infinite banking fit into a comprehensive financial plan? Well, here's the interesting thing. A lot of the times when people build plans, they have a lot of assumptions that go into them. And those assumptions can dramatically impact where the plan goes, what happens with the plan, right? If you were building a house and you had an assumption of here's how much wood is going to cost for that house, and then you build your whole plan, you know, how much you're going to budget to build that house from the cost of wood at that moment, it's going to change, right? Even in the time it takes to build a house, inflation could dramatically change, right? And the cost of wood could go up. And in fact, because of how our the wood industry is currently working, that happened for a lot of people within recent memory, where they had made all these budgets and plans to build a house, and then the cost of labor or cost of wood changed, labor changed too probably, and it totally threw everything off. So you're really careful with your assumptions. And what I like a lot about using high cash value, dividend paying whole life insurance is that the assumptions that go into that are hard to change, right? It's based on what's called a unilateral contract, where it's a contract that the policyholder owns, and that the things that are in that contract cannot be changed without the owner's permission, your permission. And so they can't change the cost of the insurance. They can't, change this or that. Now, the way we build them, there's lots of flexibility on the policy owner side. How much are they going to put in? Those kind of things. So to be careful with those assumptions. But that's kind of what I like most about when you're doing comprehensive financial planning, you have to be really careful about what assumptions you're putting into the models and into the numbers and all of that. And a lot of those assumptions are more steady, more predictable. So you can actually trust the plan. Sure, you got to check in on plans and keep editing them to get closer to them, but you can actually trust that the numbers that are there are pretty close to what you're going to see. And when there's been too many people who have counted on other things where the assumptions can change dramatically, hello, stock market, bonds, mutual funds, that they've not, kept pace, and they've seen that their plan was totally off kilter by 30 years later when they're looking back at it. So that was kind of a little bit of a soapbox rant there, but that's, I think, really crucial and important to remember.
Awesome. That was a great answer. You could be on Jeopardy. I don't know. Um, what are the key differences in approach when advising clients on the infinite banking strategies versus more traditional financial planning methods? So, that strategy, but also the traditional methods that you learned, and how's that different?
So I don't like one word in this question, the word traditional. I think what AI is really meaning is conventional, because traditional, right? If we go back 100 years plus, right, we see it was more common, more traditional for Americans to own life insurance and not own stocks, bonds, and mutual funds. It's actually more conventional today, but that doesn't mean it's traditional. So I'll give AI the benefit of the doubt there. They've been taught by humans that use that language, but whatever. So rather than just go back to what I was talking about in the last question with the assumptions, because it's a big deal, right? The assumptions that go into the plan. Let's think about how people build. A lot of the time, people build kind of upside down. They invest money because they think, if I don't invest, I'm not going to keep up with inflation. I'm going to miss out. That FOMO idea is strong. And only after they've invested do they build some strong savings and think about balancing their risk and diversification and all those kind of things. I think that's often backwards. That might be best for, the sort of the financial professional that's helping you, making a lot of money off of your assets under management versus your savings account or your bonds, right? They're not going to maybe make as much there. Or your treasuries or your whole life that you might add to balance out your portfolio. So that might be beneficial to them. But what's beneficial to you? And I think having that strong, solid foundation of savings and then investing only what you can afford to lose and putting investing in its proper spot is a very wise, very historic approach to financial planning. And that's why I love to talk about foundational wealth, because once you've built that safe foundation, hopefully using something like whole life insurance, but you could build it on savings or other, safe products. But once you've built that, now you can afford to take some risk. You can take risk from solid footing, so that then if the risk doesn't work out and you lose money, you've still got that foundation under you. And unfortunately, too much of the conventional approach risks first and then build safety later, or only a minimal amount of safety before taking risk.
That goes really well with our next question, which again, Amanda uh, kind of saw it for a second, but not really. How does infinite banking interact with other financial tools and strategies in terms of risk management and wealth accumulation? Because you kind of alluded to that, but I'd love to hear a little more.
Or AI would, right? um, so here's the interesting thing. So we have the assumptions that go into the plan, and then we have building the plan from the bottom up, right? From the foundation to the risk. But when you look at how the plan is actually working, what's awesome is when you have that foundational wealth, is that you can leverage that for some of the risk if you want to, if you're ready to. Um, we see lots of clients do that in terms of real estate. You often need a down payment for that real estate. Where's that down payment come from? It comes from your foundation. It doesn't come from what you're already taking risk on most of the time. Rare exceptions. It actually makes it riskier if you're using things already at risk to then put that down payment on a piece of real estate. So that's kind of what's fun, is that you can take this foundation and you can turn it into investments. You can invest it on purpose. And particularly, that works out super well for those who are patient and wait for an amazing opportunity that doesn't come very often. And this is when, we've had people turn $1 million into $3 million within a short amount of time. When we've had people get over 100% return on their money in 18 months. That's not true for everyone all the time, obviously, but those who have the money, opportunity typically finds them. They're able to take advantage of those opportunities. But if your money's tied up, particularly in a place that maybe is impacted by an economic downturn, you're not going to have the money to go take advantage of those opportunities when they come up, right? They say the most money is made in the stock market when on its way down. That money is going somewhere. Someone's making that money. What if it could be you?
So you said a whole lot there, but from your experience, what type of clients or financial situations tend to benefit the most from incorporating the infinite banking yourself type principles? And where have you seen it work? Where have you seen it not work?
I love that you're interpreting what I meant to ask. So the right, no financial concept is right for 100% of the people 100% of the time. That's one of the big misconceptions out there, is people do this or they do that because they think that what they heard on YouTube or on a podcast applies to them, and so they think they have to do X, Y, or Z, when they don't have somebody who knows their specific situation helping them decide, actually, is this beneficial to you or not, particularly when it comes to like tax saving advantages. Not everybody needs all of those all the time. But the same thing with using high cash value dividend paying whole life insurance. It's not right for everybody. I think it works best for when somebody is a saver already, or they're dedicated. Now is when they are going to be a saver, and they're not, like, they want to save money. They're not looking to go more into debt. They're looking to have that financial stability under them, of safety, of savings that they can then build off of and take more risk in the future. Some people often believe that you have to be a specific age or under a specific age for this concept to work for them. But that's actually couldn't be farther from the truth. We have people who start policies on their 3 months old, all the way, and people into their 80s that start these kinds of policies, and everywhere in between. Sometimes on themselves, sometimes on someone else. Um, the the thing that sets them apart, though, is that concern for safety, the concern for not having the IRS take a whole bunch of their money all at once, the concern for continuing to grow, not just keep it safe, right? You could keep it safe under a mattress, but have it grow, and have it grow while you still use it, getting your money doing two things at once. Those who find that attractive, they're willing to take some of those sacrifices that it takes to get it started to make it happen. It's not always the case that there's a sacrifice, but if there is, they're willing to take it because they see all of those advantages. I kind of got rambly there at the end. Do you have any follow-ups or ready for the next one?
So that does go into our next question. But before this question, if you think this is something you even would want to have a conversation about, Ben's going to tell us a little bit about how to work with us so we can help you build the right tools that, if this works for you.
Ready to take the next step towards securing your financial future? Whether you're planning for retirement, saving for your dream home, or you just want to make your money work harder for you, the team at Wealth Wisdom Financial are ready to assist you. And now, it's easier than ever to see how we might give you a boost on your financial journey.
Schedule a 15-minute discovery call with one of us today.
And let's discuss your questions and your financial goals together.
Don't wait any longer. Your financial freedom awaits. Schedule your discovery call at www.wealthwisdomfp.com/call.
All right, thanks, Ben, for the that little commercial there. Again, if you think that this is something you might want to integrate into your portfolio, totally reach out. So just go to wealthwisdomfp.com/call. So, Amanda, you were alluding to some of this that you didn't even know you were going to get into, but how do you address concerns about opportunity cost? People always think about, well, it cost me this amount to have this. When clients consider allocating funds maybe to this kind of policy or other investment options, and how do you help them think through that and consider both the pros and cons?
This is a fun question, hard to answer on a YouTube or a podcast because you have to think of what's the general principle that applies to more people. Because there's been so many specific situations. I've seen people get too big of a policy; they're putting too much of their money in when it could have been used for something else. Or some people get too small of a policy and they have all this money they want to put in, but they can't. And like everywhere in between, there's so many ways this can not be, right for the person because it does need that comprehensive financial analysis to make sure what is built is best for that person. Every plan should be customized and tailored to that specific individual and their family, their goals, their hopes and dreams. But in general, let's see, what could I come up with? Let me give you this analogy. This is one of my favorite hypotheticals to give folks when they're thinking of, well, I have this amount today, whether it's 500 bucks a month that, and should I put it into whole life insurance or into a Roth IRA? Or I've got $100,000 that I inherited from my grandma or from the sale of a home. Should I put it into whole life or should I put it into a CD or, something else, right? They're looking at these options and comparing. What I love to invite folks to do is imagine you're walking down the road of your financial journey and you come to a fork in the road. And there stands Gandalf the Grey. Yes, I'm a nerd. And rather than saying, "You shall not pass," he says, I know your future. I know which path if you go down these paths, where they're going to go. If you go on the left path, you're going to reach your financial goals more quickly, but you're taking a little more risk. So 20, 30 years down the road, you're going to be in a worse place. If you go down the right path, you're going to hit your financial goals maybe in a couple more years, right? It's going to take you a little extra time to reach those. But 20, 30 years from now, you're doing a much solid footing. You're going to be more, happier with your life. You're going to be really glad that you made the decisions and delayed your goals a little bit. Which way do you go? Do you go left or do you go right? That's a hypothetical that I made up, but I found it really useful for folks to think of. How risk averse are they? Or are they, happy to take some risk knowing they could be in a worse place longer term? And that tells you a lot about what kind of financial options you should go after. And if you were going to go down the right path, the one that you reach your goals a little more slowly, but longer term, you're more stable, you experience more joy. I think that's the kind of person that dividend paying, high cash value dividend paying whole life insurance is for. What's commonly referred to as infinite banking or banking yourself. And we're banking yourself professionals. Whereas if you would go down the left, it might not be for you today, or it might be for you in a smaller capacity, right? To help build maybe a little more stability, help you take risk in a different way going forward. But for most people, I think the majority of folks, they want more stability long term without delay, like without not reaching their goals, right? But if it takes them a little while extra to get their goals, they're okay with that. And so as you're looking at which do you go with, which do you go for, you want to think about your risk profile. And then you also want to think about your goals, both short term and long term. Forget about all the math, because remember the assumptions. Let's go back to question one. The assumptions that went into that math, they could totally turn out to absolutely different than you thought it would longer term, right? So sure, think about the math, think about the logic there. But really when it comes down to it is you have to think about your risk profile and your unique goals and concerns.
So yeah, I have a follow-up question, and one of them is more on you personally. You've done the CFP, you have seen some of the language out there, but you've also have not just a couple policies, but multiple, and you did not start them all at the same time. How have you both moved in that direction started with maybe smaller ones, how many policies do you have? And then how do you decide when it's a good time to add more? Because again, you said maybe they started too big or too small. And what do you do with your clients? You talk to them at all after you sell a policy for to them? And how do you help them with your mass CFP knowledge about taxes and all the other things?
There's a couple things that I think are really important when you're working with a financial professional, whether they're a certified financial planner, a bank and yourself professional, or whatever. They One of the most important questions you can ask them is, what do they do with their money? And are they, selling you something that they don't have? Are they suggesting you do things that they don't do? And with, exception, right? There's going to be times you might be in a specific life stage that they're not in, and, things like that. But particularly with high cash value dividend paying whole life insurance, I had started using this as a client first, a little over 10 years ago, almost 11 now, when I first heard about it. And I adopted it. It really transformed our financial futures. Yeah, I had been a little bit of a saver before, but this really kicked me in the butt to get me to save even more and become a responsible adult in my 20s, late 20s. And that has dramatically, now that I'm in my late 30s, I guess I just said my age there. Was 10 years ago when I started. Sorry, I just totally distracted myself. Like, it's traumatically impacted the last decade of my life. And I only talk about this and introduce it to people because of how it's changed me and what it's done for me. One important thing to know is that these podcast episodes, all of them, this one and included, we're never trying to sell people something. In fact, like, we're actually pretty bad at sales, if you can't tell. What we love doing is educating and helping people make informed decisions. And when we're talking about something that we took the time to learn about and deep dive on, this, banking yourself and other wealth building strategies that are safe, and we're the safe money specialist, that is really powerful. That we did this research ourselves. We learned and confirmed it was right for you. And that's all we're doing, is helping people learn and confirm if it's right for them. And that's what your financial professional's role, I believe, should be. Sure, they might do a couple things for you. They might pull the numbers for you. They might, talk to the insurance company on your behalf, those kind of things. But ultimately, they're empowering you to learn and confirm what's right for you. If they're ever saying you don't need to learn that, I think that's a big red flag. The other part of it is how I've used it. So we're getting long here. Maybe we need to do a whole episode about this. And we have talked about it in the past. About 2.5 years into starting the policy, took our first policy loan to pay off student debt. Then we also got through a big emergency in our former business. Through the policy, we took a trip to Ireland. We used the policy to make a down payment on our first home, to put windows on that home, to pay our taxes. The Internal Revenue Service, when we pay them money, that's all opportunity cost, like, paid too, right? What that money could have grown into. To pay that from a policy loan, it's still growing for us for the rest of our lives. Now, that's not right for everybody, but that's one thing that works for us as business owners, to do it that way. And to buy an office condo, the place where we're sitting right now, we used a policy loan to do that. We're doing some more real estate investing. It's really part of why I like the name Infinite Banking. There's an infinite smorgasbord of opportunities, even the last 10 years, as well as going forward, to pay off debt, to get through emergencies, to take advantage of opportunities, both for fun and to build our wealth. So much fun there. As I wrap us up, I will remind you that as you are learning and confirming what's right for you, and as you've adopted these policies and you're still reminding yourself of the philosophy and the strategies and how you can use them, remember that when we've taken all these policy loans for different things, we've not only been a responsible saver on the beginning, but in repaying those loans, we see that as growing our savings, continuing to increase our financial futures, and be good bankers to ourselves. So don't forget that part of it too. It's always about safety, responsibility, and taking risk when you want to, in a controlled way. where you always stay in control of your financial future. That's what we're all about here at Wealth Wisdom Financial Podcast, and we hope that you will want more safety, control, responsibility. Adulting even in your 50s, you can learn more about adulting and take that next step on your journey. We're here to help you do that and look forward to talking to you soon. Don't forget, hit that subscribe button. And if you'd like to see us do a debate style episode, debates are kind of popular right now for very obvious reasons as we're putting this out there. If you want to hear Brandon and I debate, put your comments on the YouTube channel. You can put a comment of a question you'd like to hear us debate about. Dun, dun, dun. Okay. Might be coming to you in the future. So don't forget, hit subscribe and the notification bell on YouTube so you get alerted of future episodes. This podcast is for general information only and not for the purposes of providing legal, accounting, or investment advice on such matters. Please consult a professional who knows your specific situation.